Let's go to Kyle. Kyle, who'd never heard of her before. Okay, what's Suds in the Bucket about?
It's hard to tell. I'm not very much a lyrical person when it comes to these songs. What's the most famous song she's done? Because I swear to have heard her voice before. That isn't her most famous song, is it?
Let's see. What's Sarah Evans' favorite?
It was Born to Fly was her first one.
Yeah, Born to Fly, right? She's got some great songs, just really good
No,
songs.
no place that far.
Suds in the Bucket, I Could Not Ask for More, right? Born to Fly. So she's got a lot of great hits. Anyone else want to tell us what Suds in the Bucket is about? What it means to y'all? Suds in the Bucket.
Is it about finding love at a young age and falling head over heels?
Yeah, I think so. And for me, Brad, I'm sitting there thinking I've got my oldest daughter is 17, right? So she'll be 18 before long. And you think about her graduating high school next year, and the day's going to come, where some dude in a pickup truck's going to come up, pick Abby up, and I'll probably never see her again. That's what it was to me, that coming of age to where, look at there. Now her daddy's in the kitchen, staring out the window, scratching and racking his brain. How can 18 years just up and walk away? That's kind of what it meant to me. I'm sitting there going, you look at your little baby growing up, and all of a sudden, someone rolls up and they roll away. Our little ponytail girl growed up to be a woman. Now she's gone in the blink of an eye. She left Suds in the Bucket and the clothes hanging out on the line. I just love it. I love it. Something that for those of us who have children, the day's going to come where they're going to kind of run out. It's like my mama said to me. She's like, Bubba, when you got your driver's license, it was like I didn't see you for like 5 years. I got my driver's license. Mama went to me to get them. Then my vet, we drove the vet to get my driver. What are you laughing at, Beth? Yeah, the Chevette. Beth's in the background laughing. It was a Chevette. And I brought Mama home and said, get out, Mama. And I rode off. So, yeah, poor old Nana. So, kind of cool. I think that's what that song is about. So we wish Sarah Evans well. We hope that she and Jay or whatever, if their divorce goes through, whatever, hope it all works out amicably and nobody tries to run over anybody and kill anybody, because that would be just a tragedy. All right. So you guys have made great strides on your spreadsheet. And I'm still looking at some of y'all's, and some of y'all have sent them over. But why don't we pull up Doug's? Doug, you mind if I pull yours up?
Go ahead.
All right, so let's pull up Doug's spreadsheet. He was the first one, I think, to complete the back test. Now, Doug is, his was the one that, correct me if I'm wrong, Doug, but you started 50% in
Yes,
TQs and 50% in cash, right? And you did no rebalance.
correct.
All right, so kind of discuss your results with us, Doug. Just kind of tell us what went on, what you learned through this process of the back test, what your conclusions are.
Yeah, so it's definitely appeared to be a safer method than being in the market. I think I mentioned this on some prior classes. You're holding on to an awful lot of cash, which, as someone who thinks you should be mostly all in or almost all in, this was a really uncomfortable place for me. I was really struggling with this. And I don't know if I did something wrong in terms of the calculations, in terms of what did QQQ really perform that well over that 12-year period?
Yeah, it really did. And so, QQQs did well. So think about it, the TQs are 3 times as much. Now, what you'll figure out is with a leveraged ETF, the overall return is not 300 times what QQQ would have done because it resets daily. So it's in fact over 300% better than what the Qs would have done. But I'm sorry, go ahead.
No, I mean, I was in shock because of the rate of return that I calculated for the QQQ for this period was like 374% per year. I mean, just astronomical. And I don't have it up here, but I want to say the balance, if you were just in the QQQ, was what it was a little over $3 million at the end of the 12 years, which blew my mind. So what I'm struggling with here on this whole thing is I don't know. It's hard for me to compare these results with the QQQ because I've never seen anything like that before in my life. And to be perfectly honest, I mean, divide 476% by 12, I would be very happy with that annual return any day of the week. So as I mentioned, I think in my write-up, I'd love to see a comparison of this versus just the S&P over the same time period and how that would have turned out. But I didn't want to do 144 more entries, so I did not take that extra step to look at it.
Well, this is great work. And so what happened is a $50,000 account that had 50% in the TQs and 50% in cash. So you started investing, not the 50,000, did you? You started really technically with 25,000. So
Correct.
to be able in a period of 11 years to go from $25,000 invested to a net lick value of 288,000 is just astonishing. What is more astonishing, ladies and gentlemen, is that look at the amount he's got in cash. Of that $288,000, Doug has 250,000 of that in cash. So it left you with only $38,000 in the TQs. So you almost are at a point that you go, what if the TQs went to zero, went out of business? You don't even care. I mean, you would have lost the $38,000, but you know, you've got $250,000 that is safely tucked away in cash. So what an amazing, and here it is kind of the graphical representation. Here's the percentage that's in cash and the percentage that's in TQ. Can you imagine? I mean, you made 240% in a safe amount as possible. Now, what was your maximum drawdown? Do you remember what that was, Doug?
I want to say it was like 24,000.
And that happened, was it the Corona crash or?
It was the Corona crash.
And the Corona crash that did that. So very, very, very good results by doing this. Now, how can we improve upon this? That's the question. Doug, you said you're uncomfortable with the amount of cash. So what could we do to even make this better?
Well, I think the next thing would be, I'd like to see what the other group comes up with. What was that, a 70-30 split the other group was doing? I think that could definitely improve this scenario. One thing that I was scratching my head on a little bit is when there were some dips, there weren't a lot during this time period, but there were some dips. I thought it would buy a little bit more than it did. I was a little shocked by the amount that I was buying, considering the amount of cash that I had on hand. So I guess, I mean, maybe, would you ever override it if you felt compelled to? I don't know the answer to that, but I'll throw that back out to the group.
Yeah, I'll give my thoughts. Anyone else got any thoughts on what we can do to improve upon our results? In other words, we're holding a significant amount of cash. So the cash in our thing is 86%. So we're only 14% invested. What is something else we could do to maximize our returns and get more into the market at one of the most opportune times to get into the market? What is something else we could do?
Isn't part of it just that aim high?
The aim high, right? So what we did here was aim with doing the 50% in stocks, 50% in cash. Yes, exactly. So the aim high that Lucello talks about is 80% invested, 20% in cash. That's potential. But what could we potentially have done in this exact same thing? Had we started 50-50 and we didn't rebalance through the time, what could we have done during the Corona crash to have increased our returns and got more money into the equities when everybody else was running out? That's what I want you to think. You got to think, guys. What would we do? You've got to have.
Our own cash?
What was that?
Can we bring in our own cash? Bring in more investment from outside?
Exactly, Jack. You could put more outside cash in, but you've got so much cash on hand. Why even do that? Why not put some of this $249,000 in cash to work at the same time everybody else is scared to death? Remember, if you and I are going to develop wealth, you've got to have contrarian thinking. So we need to run into the movie theater when it's on fire while everybody else is running out because they're scared to death that they're going to burn in the fire. So when the market's on fire and everyone else is getting out, that's when you and I need to get in. So what I would suggest is, let's look at March 2020. Let's see what happened around that time. So here, there was a $15,000 loss, right? But he still had $142,000. He had $192,000 in the account at that point. A substantial amount of which was, but look at that, y'all. I mean, that's no drop at all in $192,000, you know, with what happened in March of 2020. What I would encourage you to do is to do some sort of rebalancing during that period in time when the market is down significantly. So what he could have done at that time, so now he's got 14% in this, 80% in cash. So what he could have done is at that moment, he could have come in and did, let me do 0 here, 50% cash. So if it had been during March, take the signal. Here's the signal you go toward. Go to the quarterly rebalancing, and maybe we should change the name of this to just rebalancing, right? To do it whenever. But what should have happened is when you see it go down, come back over here and go, okay, I'm only 14% in. Let me move my allocation back to my original starting place, 50%. And if that were the case, and let's pretend it happened today, he would be buying roughly 1,700 shares. That's how you improve upon the results. So let's say if the Olympics end, I've not watched a single bit of the Olympics. I don't know if anyone is watching the Olympics, but if the Olympics end in a couple of weeks and China invades Taiwan and Russia invades the Ukraine and the market goes down, you know, 10% in a day or 15% or 20%, let's just say we have a huge drop. That would be a time to open your spreadsheet, look at the amount of cash that you've got. You go, God, I got 249 cash. Come to your rebalancing tab and go, well, if I'm 14% here, why don't I go up to 25%? You know, you don't have to go all the way back and go buy 534 shares. So there's ways to use this and improve upon the results of just simply letting AIM run and going in at the most opportune time. Remember, when everyone else is running out, that's when you and I run in. That's where true wealth is made, by having a contrarian mindset. Remember, one of the things that I assert is that conventional wisdom is often wrong. Conventional wisdom is often wrong. Take, for example, the status of academia within the United States and how we teach investments. We don't teach you how to lower your cost basis. The best way to lower your cost basis in something is to buy more of it when it is depressed, when that asset is depressed, and go in and buy more. Now, I would never do this on a single stock. Why? Why would I never do this on a single stock? Let's say I go all in and Netflix was down huge the other day. Everyone saw how bad Netflix got hurt. So why would I not double down on Netflix?
Because
There's
one
too
stock
much.
could go all the way to zero.
Netflix can go all the way to zero. Netflix possibly could go to zero. Netflix possibly could be Blockbuster. Remember, for those of you who are older, we would go on Friday nights, we go to the Blockbuster and we check out movies and take them home and we be kind and rewind, right? And now Blockbuster is gone. It's a nothing burger. So you and I don't invest in those individual stocks when they're going down, but we will invest in an index composed of quality stocks, because if Netflix goes out of business, it will be kicked out of the S&P 500, it will be kicked out of the NASDAQ 100, and it will be replaced by another quality up and coming company. Isn't it beautiful? It self-cleanses. It self-cleanses. It does not have to go through all the stuff that we have to go through of picking stocks. Now, some of you are going to leave my class and you're still going to pick stocks. That's fine, but you're still going to underperform the market. I don't see you as wanting to be underperformers. I want you to outperform the market. There's no need in you trying to be the next Warren Buffett. You and I are not the next Warren Buffett. All right. Has anyone completed any of the other two that would like to share? And I apologize. I've not looked over a lot of them yet. Your assignment's still not due until the 20th. So everyone chill out. Some of you have sent me some to look over. I'll get those to look over. I'm a little bit behind. But has anyone else got to share some of their results that were in one of the other groups?
Yeah, I was in section 2. So I had a 70-30 balance at the beginning.
Kyle, and have you completed yours? Can you share your screen?
I can't share the screen. I'm sorry. I used my iPad
fine.
For the recording.
No
so
problem.
I have, it's not that, it probably is not that different. Can you go on the one that you have up right now and go to AIM activity?
Yep.
That tab.
Mm-hmm.
So I was, the whole time I did the idea of like, okay, you buy low and sell high and this thing. I was really super optimistic going through this project and seeing the numbers build up. And I got to a point where I'm like, why am I selling all of these shares? So you see how the first one on your screen says 43,000 shares bought. Mine is 60,000 shares.
Okay.
So if I just went buy and hold, and I bought, instead of doing a 70-30 split, and I just did buy and hold, I would have been 100% invested in $50,000 at the beginning, right?
Okay.
So I would have owned, what is that? 50,000 shares divided by 58 cents a piece. That's 86,000 shares. So if I had just bought and hold at the beginning of this, I would have 86,000 shares of TQQ. I go on to Google right now and I look it up, and TQQ is worth $58.96. I put that into my calculator and I have $5 million. So how is this beating buy and hold?
Excellent question. It's an excellent question. So, how did you end with, tell me again how you ended with the AIM?
Yeah, I'm sorry. You might be able to pull it up on your computer possibly. So my final number, it was higher than the other one, probably because I had more, I was 70% in instead of 50% in. My final net liquidation value was $378,000.
Okay.
So it's about 100,000 more.
And approximately how much of that was in cash, Kyle?
Current cash is $318,000. So it's like 84% is what it says.
84%. Okay, good. So you outperformed the 50-50 no rebalance, and yours was 70-30, right? 70-30?
Yes.
With no rebalance.
Correct.
Okay. So again, yes. Now, what you accomplished was even better than the 476. So nothing to sneeze at, but I see what you're saying. Bobby, I should have just gone 100% into TQQQ and never looked back. The only problem with that, Kyle, is if you are in a buy and hold scenario, yes, buy and hold will beat the Lacello AIM method if there's pretty much a 100% bull market. And that's pretty much what we saw from 2010 to 2022, just a runaway bull market. You absolutely will. Now, what you'll find is that the drawdowns are much more significant if you had been 100% invested in the TQs, right? So there's a good chance that you would have seen a 60% down move. So if we look at, let's go to portfolio.
I lost $1 million the last month.
Yeah, you lost $1 million last month, right?
If I would have just been in buy and hold on QQQ.
Uh-huh.
Yeah, but you'd have lost $1 million on $5 million. You'd have $4
well
million, right?
Yeah.
I've just, I've been biased towards buy and holds and everything. And it's just, I get the advantage of having cash on hand, but it's like, I'm kind of thinking that AIM works better if you have a short time horizon. But if your time horizon is 20 years, I'm not sure. I don't know. I just, I thought the numbers would be bigger than they were, but maybe I didn't do the sheet entirely.
All right, let's do TQQQ. If you put 100% in there, Beth, will you get that damn dog out, please? Sorry, y'all. All right, so let's do $50,000 in TQQQ, right? And let's run it from 10,000 to 2022. Where would you be today? Now, guys, this is powerful. Oh, no allocation. Let me put 100% in there. 100%. Let's look at it. And let's just let's compare apples to apples. You would be a very wealthy person today by just starting out with $50,000. So you would be at the $4 million. You'd be making 48% per year. Your best year, 139, your worst than negative 21. And your max drawdown would have been 50%. And that would have occurred from February to 20th. So right here, right? So you would have gone from $1.5 million to $774,000. Hey, and Kyle, I'm with you. If you start off with 50 and you're at 1.5 million, does it really hurt you to lose 50% of your account down to 774,000? No. I mean, it really doesn't, because you started off with 50. But if you and I were holding 1.5, how would it feel to go, you wake up today and you go 1.5 million? Man, I have made it. I am the millionaire. I'm not only a millionaire, I'm a millionaire and a half. I am the stuff. And to the very next morning, almost wake up and realize you're not even a millionaire anymore. You're down to 775. I get it. That's still a big, humongous drawdown. Now, can you, if you can stomach that, go with the buy and hold. I'm with you. But what I think we can do, ladies and gentlemen, is this. When this occurs, what a great position, Kyle, for you to be in with loads of cash in your account where you can buy in more. That's all we're saying with Cello's aim, is it's going to allow us to rebalance and go in, not necessarily every quarter or every month to rebalance or every year, but rebalance and invest more when crap hits the fan, when everybody is running for the exit. And that's exactly what happened in March of 2020. Can you imagine sitting on a pile of cash and being able to say, hey, man, let's go another $100,000 in the TQQs here. Of course, you don't know if TQQs is going down, 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 down. But to be able to be afforded the opportunity to make that decision. Now, if you're all in TQQQ, right, when do you take your profits? You don't know when to, the buy and holder does not know when to take profits. For example, let's say that we buy TQQQ and we're going to make up prices. And we're going to have a 5-year window. You buy it here for $100 a share. You're a genius, right? Because in year 2, it's at $200 a share. You've made 100%. Well, then year 3, it goes to 300. You are still Johnny Genius. Then the next year, it goes to 400. You have quadrupled your money, Mr. Buy and Holder. But what happens in year 5 if it goes back down to 100? Now, it's entirely possible. So Mr. Buy and Holder, at the end of 5 years of buying and holding, has made $0.
Hey, Bobby, my pushback on this is I don't think the average American is buying and holding. I think the average American's dollar cost averaging in through their 401k.
Right. Okay. That may be the case. And where dollar cost averaging is a good thing. That's a great way to do it, right? To add cash infusions so that you're catching the ups and the downs and the ups and the downs, and you're trying to improve upon your cost basis in the underlying. Absolutely. I agree with you there. I agree with you totally. I'm just saying, at what point do we, who have all the information available in our hands to say we're going to buy, we're going to sell, we're going to hold, what can we do to help assist us to make those decisions in a non-emotional way? We're trying to take the emotion out of it some way. So I hear exactly what you're saying. Is that what people are doing with their 401ks? They're dollar cost averaging in, they're taking some from every paycheck, they're putting it in the ups and the downs and the good times and the bad times. Absolutely. Great way to do it. Now, if you are outside of a retirement account and you're buying and holding, could that work for you? Absolutely. I think what we're trying to say is, if you can convert some shares to cash, if you can convert and to reduce your risk, because it's all risk reward, right? We want maximum reward with minimum risk. AIM allows us a little bit to do that. Now, am I jumping and saying the AIM is the end all of end all? No, I'm not saying that at all. I'm saying it gives us an option to make non-emotional decisions, to, in good times, to convert shares to cash, and in lean times to convert cash to shares. Now, with that being said, you guys both presented scenarios where you had tons of cash on the side, and it bothers both of you and even me that we should put some of that cash to work for us. So I would contend that maybe the best way is not to have an annual rebalance or monthly rebalance or quarterly rebalance, but to create some type of trigger that would tell us when to make a rebalance and to go more in shares. So maybe it's a percentage drop. In other words, the underlying that I'm in, if it decreases by 5%, then I'm going to rebalance and go back into that underlying. Maybe it's 10%, whatever the percentage is, but to have some, what I need you to do more than anything is to have a plan. Oh, how many times do we do something without a plan? So before we get out of this class, everyone will have a 8x11 piece of paper that is your plan. This is Doug's trading plan, Doug's investment plan. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And you'll have it so that you will know. I don't want you to ever wake up and go, wow, what do I need to do today? No, you got to know what to do today. Have your plan. Does that mean that your plan never adjusts? Well, of course your plan will adjust. As you become older, as you become closer to retirement, your plan can change, right? And you can amend that plan. But I want you to have a plan. I want you to know every day when you wake up, what is your plan of attack? Because remember, the market is there to take your money. It, as Warren Buffett says, the market is a way to transfer money from the impatient to the patient. So I want you to be able to go into the market and to be able to make those types of decisions, but make it in advance. I want you to think, okay, if the market were to have a March 2020 drawdown, what would I have done? So that you can now create a rule to tell you what to do in that instance. Am I making any sense at all? So I'm not saying AIM is the end all of the all end alls. Not saying that at all. I'm saying it does great at converting shares to cash and cash to shares, but I think that you and I can make some adjustments that would improve upon it. Okay, who was going to speak?
I was just going to say something. I agree with Kyle and Doug. You know, the buy and hold looks great for this, but I took a different spin on the book. It wasn't to me saying, hey, that's the only approach is to aim high. I think for me, what I was taking from it is the book was saying, you know what, most people get weak in the knees when we see a down market and we run in fear, like you said, and we're going to sell, sell, sell. I think the book was just trying to say, hey, we don't have to, have that impact on us every time there's a down market. And yes, you guys are right, Kyle and Doug, by all means, we could have made more, but for the average investor, I don't think they would. They get too weak in the knees and go run and hide right when they should be buying.
I think it's a fair point.
Anyone else?
Bobby?
Yeah.
What percentage of your assets do you run through AIM, and do you use the AIM high, the 50-50?
I use a small percentage of my assets. I think I've got like $40,000 in AIM now.
Okay.
I will be putting probably another $120,000 into AIM in an IRA in the next coming days. So we may even I may even open that account and let you see me actually run AIM in that specific $100,000 or so account. But yeah, and so on the account that I'm in AIM now, so here's what my allocation is, and we'll talk about improving upon it as well. My allocation now is this. Here's what I started at. I did 70% TQQQ, 20% TMF. what is TMF? It is a 3x leverage bond fund. All right. So think bonds on steroids. So 70-20 and then 10% cash. And I've got roughly $40,000 in that. Now, here's the problem. I said I've got $40,000 in it. I had $50,000 in it as of January the 2nd. So have I experienced a downturn with the market and the TQs going down? Absolutely. Right. I have a higher tolerance for risk than a lot of people. So it doesn't bother me at all because I've got that long-term horizon that we're looking at, right? Long-term. You know, I've got 10 to 15 years before I would ever even think that I would need that money. Right.
Are you rebalancing or are you just running it the AIM way?
I'm just running it the AIM way. I have allowed for quarterly rebalancing, but I've not quarterly. Well, I did quarterly rebalance back on the first trading day of January, or I did it on the last of December. I'm not sure about what I think about rebalancing with AIM. I think it's good, but I think it's better that we not do a daily or quarterly or time. I think it's better that we rebalance after X movement in the market. After X movement. So after X, TQQQ goes down, you know, maybe 10%. Then go, hey, I need to toss more dollars in there than even what Lucello's AIM would say. So I am still up in the air about rebalancing, but I think rebalancing is going to be something that we do need to incorporate. And that's the great thing about this is you guys all have options. You can absolutely run AIM in your account and let it go. And you saw how safe it was, and you got over a 500% return in 10 years. I mean, it's fabulously safe because most of your money is in cash. But I think there are many of you that have, including Doug and Kyle, who have risk tolerances that are higher. Doug talked about, I am uncomfortable not having all of my cash or a significant portion of my cash working for me. So he could have taken that cash and invested it in something else. You could have put it in real estate. You could have put it in gold. You could have put it in 100 other things. So it gives us flexibility. And that's what I want. I don't want anyone leaving this class and go, Dr. Bob says I got to do it X, Y, Z. No, I want you to come up with your own plan. We're working to help you develop your mindset, your plan, your investment plan, so that when you leave here, you know at least what you're going to do for the next 5 years. My plan is this. I'm going to open my portfolio once a month. I'm going to open the Lucello algorithm. I'm going to act upon it once a month. I'm going to rebalance quarterly, or I'm going to rebalance after an X. I want you to develop your own style. And I hope that none of us have come out of here going, we're all going to do the exact same thing, because some of you will go out of here going, TQQQ is insane. That thing moves like, it's crazy. So maybe you're going to invest in the Qs instead. You'll run that in AIM, or you'll do SPY, or you'll do, you could do UPRO, which is the 3X S&P 500. All different kind of things. Or some of you will still stick with your individual stocks. You could run Apple through AIM. You can run anything through AIM. AIM may not even be a part of your program when we get finished, because AIM, after all, let me give you a little on what AIM is. AIM is nothing more than a rebalancing mechanism. I'm sure I can spell mechanism. That's all it is. So your rebalancing mechanism may not even rely on Lucello's algorithm. You may say, I'll just rebalance once a month. I'll rebalance daily, every 2 weeks. Because when you rebalance, what are you doing? Let's talk about it. You're 50-50, 50-50 equities, 50-50 cash. If at the end of next month, you are 60% equities and 40% cash, what happened to the price of your equities?
Yeah, I guess you'd be selling the equities when they're worth more money and you'd be buying the bonds when they're cheaper, or the cash or whatever it is.
That's rebalancing.
Right.
That's rebalancing. And all Lucello's algorithm is a rebalancing algorithm that allows us to do that. So I don't care if you could simply say, I'm going to rebalance my portfolio every month. So what that would mean is your TQQs or your equities went up in balance. So you are, here's the secret of wealth, y'all. Don't tell anybody this. Y'all ready? It's so simple. Buy, sell, y'all help me complete it. Buy,
Low.
don't let it get out.
Quick question, when you just put the rebalancing on there, the 60-40 and that, how does like a target date fund, American funds or such, a 2040 fund compare where they're supposed to be rebalancing yearly and getting you back to your 60-40? Are they kind of doing the aim for you throughout the year, or what would you say about that?
Yeah, I think so. I think that's kind of what they're attempting to do. I think what you'll find, Brad, is that even though I think they're a little too conservative in many estimates. I've never been a fan of those. I would never put my money into one of those and one of those target funds. I just never would. And I'm more of an active. I want to be actively, involved in my decisions. I think they're a little bit too. So let's say, for example, if I am 51 today and I'm already retired, right? I'm just an old fart. I'm retired. But let's say that I'm not. And let's say that I want to retire in 10 years. So I have a target fund that has a date of 2032. Okay. My assumption, now again, I don't look into them that much. I don't look at that. This is probably a little more too conservative for me. So I would be looking at a target fund with a expiration of 2042 probably. I would bump my day out because I just think it's entirely too easy for me to have too much bonds in my account. I don't want that. So I would never do a target fund. I understand the allure. I understand people wanting to do them because you don't got to do anything with it. It sets the gear. It takes conventional wisdom of how much should be in bonds and how much in equities. Because here's the thing that I don't want y'all ever graduating from this class, and this would hurt me. If you become financial planners and here you go, I'm a 60-40 dude. 60% equities, 40% bonds. If y'all do that, I will cry. I will squall. I'll be like, oh my God, did they learn nothing more than that? No, I don't think that one size fits all. So don't come out of here being a 60% this and a 40% that and giving the same conventional wisdom that every financial planner out there in the world gives. Here's your value as a financial planner to other people. It's not in picking stocks. You're not a picker of stocks. And that's what people think financial planners are. Oh, well, they're going to help me pick the correct stocks, equities, bonds, underlines to be in. And that is garbage. We've already said you can't pick them. Where you make your money is asset allocation. Don't come out of here as a financial planner going, let me tell you something, we're going to pick Apple and I'm going to pick this. No. Because you're going to underperform the market. What you need to be is to help people allocate their resources, allocate their assets in a proportionate way that will maximize value for them under their risk tolerances. That's where your true value comes in, not as being a stock picker. Please, God, don't think you're ever going to be a stock picker. I remember, I'll tell the same stories over and over. Just forgive me if I've told you this before, but I was a broker at some little stock place in Buckhead outside of Atlanta. I got a job there. We were supposed to be there at 7 o'clock every morning. We didn't leave until it was night. And I had to read the Wall Street Journal cover to cover, as well as the New York Times every day. Then I had to do that before work. I had to scan it, the whole thing. And I remembered when I got there, they said, okay, tell me what this job is. And I said, oh, I'll be helping people to pick the right stocks to get in. They said, shut up. They said, we will tell you what stocks to push. Your job is nothing at all but a salesperson to sell what we tell you to sell. So they put me in my place really, really quick. So I started going, oh, so I have nothing to say. They said, you have not an opinion. We will come out and tell you XYZ is where our clients are going to be putting their money today. And you will do everything in your power to sell as much XYZ as you possibly can.
I can
That-
confirm.
Yeah, what was that?
I can confirm that. I worked at Merrill Lynch and there was very frequently sales contests on different mutual funds or different stocks. There was very, very frequently contest to that.
Many of you watched Wolf of Wall Street. That's kind of what it's like. They tell you what to push. You get on the phone, you dial it, remember the hit it monkey, you hit the button, and you do everything you can to put people in as much XYZ or whatever they're telling you to run that day. You have no opinion whatsoever. So you're going to graduate from the University of Alabama. Many of you are going to have this nice little diploma. It looks great, and you're going to have it in financial planning. And if you ever think that your job is to put people in the right stocks, then we have done you a terrible disservice. It is much better that you become an asset allocator for your clients and for yourself. Now, how did I retire early? And I've told my story time and time again. Little old Bobby put money in a thrift savings account, and I put it in the S&P 500 C fund from the time I was 18 to the time I was 50. That's what I did. I maxed it out. Now, did I have success in other accounts and other investments and doing all that? Yes, I did. But little old Bobby was an asset allocator, and little old Bobby, who, just some backwoods hick from Ranburne, Alabama, had the wherewithal to put 100% of his money into the S&P 500 and never think about it. And I lived through 9/11. I lived through the Gulf Wars. I invested through all the Gulf Wars, Saddam Hussein, Osama bin Laden, Kim Jong-un. I have been with all of them, and through all of them, I stuck with the S&P 500. The 500 greatest companies in the United States of America. And if you think that they're going to go away just because Russia invades Ukraine and China invades Taiwan, you are sadly mistaken. So what I did was somewhat risky. People would say, you're an idiot, Bobby. You didn't have any bit of bonds in that whole 30, 40 years that you were with the investing. No, I was 100% S&P. Through the good times and the bad times. Through the Corona crash, through the recovery. 100%. And it worked out really good for me. That's why I can tell you, I don't have to search and find the 10 best stocks to put my portfolio in. Some of you are watching Jim Cramer, and he's got this little segment that says, am I diversified? And you give him 5 stocks and he'll bless it or not bless it. 5 stocks and you think you're diversified? How diversified was I? I was in the S&P 500 for 30 years. I had 500 different stocks. Guess what? Some of those companies probably went bankrupt, but guess what? They were self-cleansed. They were kicked out of the S&P 500. Some of those companies are no longer in existence. They were gone and replaced by a new up-and-comer. I didn't even have to worry about picking stocks. Was I diversified? You dang right I was diversified. I was diversified in 500 of the greatest companies that ever have lived upon the face of the earth. And that asset of companies changed throughout the 30 years that I was invested in, but yet I was in 500 companies. Now, y'all, there will be those like my wife, right, who won't eat chicken on the bone, who'll raise their nose and go, huh, well, you weren't diversified. And I will say this to all of those snooty stoops that says I was not diversified. Diversification, y'all help me, y'all know I can't spell. Diversification is overrated. Diversification is overrated. There will be those that'll tell you that if you're in the S&P 500 that you're not diversified. And I will say baloney. Now, if you are closer to retirement, yeah, and you don't want to be in the S&P 500, you just got to have your little bonds in there. Put your little bonds in there. I got no problem with it. In my AIM account, I've got 20% in TMF, which is a 3X bond fund on steroids, right? It's a leveraged bond fund. So I've got some in there. I'm fine with that. But I'm telling you that if you're going to do this, if you get out and you start putting your clients in this, you go, okay, well, we need a certain amount of gold. Then I want you to do a little bit of silver because it's an industrial metal. And we need a little bit of crude oil in your account. And then we need a little S&P. And then we need a little value stocks. And then we need to have a little bit of this and a little bit of this and a little bit of that. I'm going to tell you that you're going to underperform the market.
Hey, Bobby, as I'm thinking about my 3-buy card for the end of the semester,
Yes,
I want to push back on AIM just a little bit more and just kind
Absolutely.
of figure out how you're using it. Because I'm picking up that if you've only got 40 grand in it, it's not really the backbone of what you're doing. It's just kind of something you play with. But it sounds like the crux of what you really believe in. It sounds like it's just dollar cost averaging in the S&P 500 over a lifetime.
In its simplest form, exactly right.
Okay. Okay.
That's exactly right. And I don't think you can find anybody here that would, that's why I shared with you the Buffett advice, right? Of, hey, S&P 500. That's what he tells us. Because we're not Warren Buffett. We can't time the market. We can't find those gold nuggets. And if we do, chances are it's going to lead to underperformance. So if you want to get market returns, go with the S&P 500 over the long term. Exactly.
Okay. You said one other thing that I thought was interesting about the AIM, and I think it's good to point out, is you said you were going to put it in an IRA when you dumped that, 150 grand, I think you said in it. To me, that makes a lot of sense versus running this in non-retirement accounts, just because I think someone put it even in the chat about capital gains. That was I had 2 big reservations, the cash and the current interest rates you earn on cash, which is 0, and then the capital gains you were creating by buying and selling all the time.
Right. You remember what on our very first class, I showed you the 10-year millionaire, remember? We started with $1. We put $500 a month away because 500 times 12 gives us the $6,000 that you and I can put into a Roth IRA. You can put more if you're 50 or over. But maxing that out and basically dollar cost averaging into that is the way to go. Dollar cost averaging into something, right? Whether it be the TQs, the UPRO, S&P 500, that's the way to go. It's not complicated. So we made you do an incredible amount of work by logging all of this, but I don't want you ever lose the lesson. I want you to know the merits of AIM. I don't want you to be married to AIM, but I think it merits a certain amount of our investment dollars. I think absolutely so. And I'm willing to put another 120 on the line, I guess, for AIM. But where the money has been made with me over my lifetime is dollar cost averaging into the S&P 500. And that's just simple as you can make it. It doesn't matter about all this other stuff. I didn't have any gold and silver and crude and value stocks and small caps and international and blah, blah, blah. Well, Bobby, you got to have international. Why? Someone tell me why. Is Apple not an international company? Is Tesla not an international company? Is Netflix only in the United States of America? You see where I'm going, right?
Yeah.
These 500 companies, ladies and gentlemen, are international companies. I got all the international exposure that I need. I don't need to buy Nestle because Nestle is, where's Nestle? Y'all can't even remember. Swiss, yeah. I like the chocolate. I don't necessarily have to have it in my portfolio. Now, I'm not advising you to not have it. Keep in mind, hey, Doug, I want you guys, I love this pushback, by the way. I love this because at the end of the day, you don't have to think like me. I told you first day when I come in here, you're going to receive my biases. Why are you going to receive my biases? Because it's worked for me, and I'll show you what's worked for me. Now, is AIM worked for me? No. So I'm showing you something that has not been the source of what I've done, but it's something that I believe is with merit and needs to be studied. Go ahead, Doug.
I had one other thought about AIM, and where I think it may, to me, makes a lot of sense because of all the cash it kicks off, is for someone that is actually retired and looking for an income stream. Maybe you convert your retirement money and put it in AIM, and it's still invested, but it's still kicking off cash for you to live off of. What are your thoughts around that?
I think that's a great idea. I think it's a great idea because that's what it does best, it seems like, doesn't it? Is
Right.
It kicks off cash, and makes the whole portfolio a lot safer, especially if you're not doing the rebalancing. All right, someone said, Mel said rebalancing had capital gains implications from my back test, big sales and big buys within 90 days. Okay, absolutely. So I think we all realize that it would probably be better in some tax advantage account. Lisa says, would it be safe to rebalance might be beneficial during wartime? Well, assuming, Lisa, that wartime brought a big drop in whatever the underlying that you were in. So yes, I mean, I think, during those periods, that's when we would say, yeah, bump it up some. So we're just trying, I'm glad that you guys are thinking, right? So you're thinking, because here's what you're thinking right now. You're thinking that I've got to have 10 different funds in my portfolio. And that is not correct. Because if you start adding all of this garbage, you're going to guaranteed to underperform the market. What is the benchmark for everyone, y'all? Just about everybody has a benchmark. It's the S&P 500. We're not saying that the S&P 500 is going to be positive every year, but if you will dollar cost average into the S&P 500 month after month after month after pay period after pay period after pay period, you're going to have a really, really, really nice nest egg at the end of X number of years. I love it. Who else got questions? I want to show you one more thing before we leave, because this is great. This is great. I love the discussion. I love that you guys are thinking. So remember what Karen said in our Karen video, regardless of Karen's problems and all this. She said, the simpler I made it, the more successful I became. And I really want that to resonate with you. Simple, 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 simple. And we told you the secret is to buy low, sell high. Watch this. I'm going to show you how you can do this, but in an opposite order. Buy low, sell high. Everybody sees buy low and sell high, and they think that one has to come first. You think that, well, this has to come first. You got to buy low to sell high. No, you can actually sell high and first, do this first, and buy low second. Anybody know how to do that?
Options.
Options. Exactly, Brad. You've already done that. How most of you sold your put? How's your put doing? Is anybody up on your put? Are you down on your put? Anybody looked at it, see how your short put's doing?
I'm trying to look at mine, but I cannot read the software. I don't know if you have that program. I wasn't able to make the call for the video on Thursday. I was down in Tuscaloosa. So I was just trying to get mine set up the way that you were. I don't know if you could resend that link for those of us that weren't there.
Yeah, I can resend the link. Let me share that with you real quick. So
That took a hot minute to do. I wasn't able to do it from the link. I was able to do it from the Blackboard where you posted it on Blackboard. I was able to do it from there.
Okay. So how is your put doing? Your short put doing?
I should look at that.
Yeah, everybody see how your count's doing. How's your put doing? What did you sell yours in?
SPY.
SPY, okay. I don't know exactly how SPY's been since you sold it, but it'd be interesting to see at least how your put's doing. All right, let's look at selling a put. So what I told all of you to do was to go out, you know, roughly 45, 50 days, right? And to sell a put. So let's see what one looks like. And I told you to sell one that has a 30% probability of being in the money, which means it has a 70% probability of not being in the money. So as we look at this, this trade has a 77% probability of making a profit. It has an 87% probability of making 50% profit. Your maximum profit on the trade is $646. Maximum loss if SPY went to zero would be $42,054 on selling the 427. Let's see if we can look at what this looks like. Let's look at the curve and the analysis tab. Yeah, isn't this beautiful? So here's where here's the break even, right? You got a break even here of roughly 420. You make max money if it's above the strike, the 427. So you would get to keep that maximum credit, regardless if the stock goes up, 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 up. You only lose once you go down below that break-even point. So everybody sees what the risk profile looks like on a short put. Okay. Now, so that was the 427 put. Let's go and revisit this one more time. So we just sold the 427 put. Sale 427 put. All right, someone tells me if at expiration, and let's say you wanted to buy SPY at where it's currently at, and SPY is at 449. So you'd be getting a great deal on 100 shares of SPY if you were. So if this expires in the money, so the price of, let's say SPY at expiration closed at 425, then you're going to be put 100 shares at 427. So you got 100 shares and you're put those at 427. Okay. Now, keeping in mind, now that you own 100 shares, your option is gone. What can you now do? This is one of the simplest things in all of options, and you probably heard it before. What could you do with 100 shares to now turn this little thing into a cash cow? I know y'all have heard of this.
Yeah, wouldn't you do the opposite and sell the call? Does that sound right?
And it's called, right, you sell a call and it's called a covered call. Why is it called a covered call? Because you own the shares.
Right.
Right. So if you sold one call against your 100 shares, and let's say that, you know, you got it assigned at 427. So let's say you sell the 430 call. As long as the price of SPY is below 430 at expiration, you get to keep that entire credit. Right? That entire credit's yours, and you get to keep the shares. Now, what happens if you sell the 430 call and the price of SPY at expiration is 431? What happens to your 100 shares?
You have to sell them at 430, but there's a built-in gain for you of $3 a share.
That's correct. So you don't have to sell them. They're called from you, right? So you don't have to go in and hit a sell button or anything like that. They are automatically called from you. So at expiration, you now own zero. You own nothing. Your shares have been called away, but you get to keep that premium that you got from the sale of the call. All right, so now you're bullish on this again. What do you do now to get back into SPY?
You sell another put.
You sell another put. If you don't get assigned shares, what do? Well, you sell another one, keep the premium. Sell another one, keep the premium. Then if it goes down below your thing, you take assignment. Then what do? You sell a call against it. You're creating income from your shares. You remember when I took you through the example of the hunting land? Let's say you own 100 acres in South Alabama and it's just sitting there. And you're paying taxes every year. And that's like owning a stock. It pays no dividend, let's pretend. You get no dividend from it. And, you know, it makes no cash flow. You can turn your shares into cash by selling options around them. You can sell a put. Once you own the shares, you can sell for every 100 shares that you own, you can sell a call against it. So if I own 500 shares, I could sell 5 covered calls. So let's look at that. What does that look like? So let's say that you got to sign shares, right? You're signed shares and for some reason you own 100 shares. How do you sell a call? Same way. You go out, maybe close, and I'll tell you why we go closest to 45 or 50 days after a while. So let's clear this order. And let's now go closer to 45, 50 days, and let's sell an out of the money call. So here are the calls on this side, bid and the ask. So we would go to one that has maybe about 30% probability of being in the money again. So yes, you're going to cap your upside. So if SPY is at 448.50 now, right? You're capping your profits to the upside. So you're not going to get to share in anything that goes above your strike. So let's pick this one here. Here we go. We could sell with a 30% probability of being in the money, $5.53. Everybody understands I'm going to be taking in $553. Now it says your max loss is infinity, but that's not true because you actually are owning the shares. This has a 70% probability of profit. I like those odds. And it has a 93% probability of you making at least half. So $225 on this trade. Now let's look what this looks like. Here is what a short call looks like without shares. So if the price stays below your strike, you make the full premium. If it goes up above it, you start incurring losses, but that's not entirely true because you own the stock. Let's see if I can actually put in the 100 shares on here as well so you can see it. Let's see if I were to click on the bid. Short, nope, I need to click on the ask. The ask. Yeah, so there's what a stock ownership looks like, right? 100 shares there. 100 shares looks like it goes up, you lose money. It goes down, you lose money. What does the short call look like? Let's put the short call on there. And go back to the table. 45 days or so. Selling the 30 delta. 548. See what that looks like. And there is the this is what it looks like with 100 shares and the short call. So now we've got everything in there, right? So you got your profit here that is maxed to the upside. So remember, if you adjust on the shares, this looks like this, right? Your profit goes up, up, up if you just own the shares, right? Unlimited profits. By selling a call, you have capped your profitability to the upside. So why would you do that? Why would you do that? Anybody? Why would you cap your profits to the upside?
Well, don't you have a higher chance of getting the profit in the first place if you do that? Aren't you letting someone else assume some of the risk?
That's correct, right? Because then you're saying, yeah, but what if it doesn't go up? What if it goes down? Well, you've brought in additional income, right? That is kind of a hedge against your shares if the shares do go down. You've increased your profits, your loss is not as much to the downside because of the income that you take it in by selling the call. Now, what this is called, ladies and gentlemen, you do a lot of research on it, but this is kind of one of the simplest things, right? So what this is called is selling a put to acquire shares, shorting a put to acquire shares. Then once you are assigned, you're selling a covered call. If your shares are called away, then you sell another put to acquire shares. If your assign shares, then you sell another covered call. This, ladies and gentlemen, does anybody know what they call this? It's got a lot of different names, but the one that's probably most prevalent out there, if you're searching around, is it's called the what?
The wheel.
The wheel. Selling a put to acquire shares. If you're assigned, sell calls against those. If they're taken away from you, sell another put. And just over and over and over. In other words, it's a wheel, right? This little activity just keeps over and over and over and over. And it's one of the most simplest of all option strategies. Just simple. Just simple. So I probably
When you,
yeah.
I'm sorry, when you sell a put, do you wait until, because I have my the paper money up, and I'm just wondering, so when you sell a put, do you only get your money once the put expires? Or do you have to take some sort of action in order to get someone to take it? It's still a little confusing to me.
Sure. Okay. So if you sell the put, you collect the premium, right? So you get to keep that premium. Now, as long as your put expires out of the money, in other words, the price of the underlying is above your strike price at expiration, you do nothing, and the put just expires. The premium is in your account, all is good. If it expires below your put, then at expiration, you are put those shares. So there's really nothing that you have to do. Now, what we need to talk about next time is we're going to talk about early management. Because Kyle, here's the interesting thing. You can improve your probability of success by managing early. I rarely let options go to expiration. Almost never let options go to expiration. I almost always will manage those options early, and we'll show you that next time. But what we've had today is a really, really, really good discussion. And I love where you question, hey, is this absolutely the best strategy? Is this it? What if we did this? What if we did that? Never think that in this class you can't do that. I love it. I love that you guys are thinking. It's really great. It's refreshing, actually, to have people who are thinking and say, hey, what about this? What about that? Yeah, but this. I love it. Love it. Who's got any questions before we go for the day? It's been a great class today. Really good. Y'all been very involved. It's really good. How you feeling?
I have a question.
Yes, Lisa.
On the paper money on Thinkorswim, do we kind of have free range of when to buy and sell on it for our own experience? Or is this a set of when you want us to do it and when not to do it?
No. Play away. Have fun.
Okay.
Play away.
Because I've been trying to be a good girl and say, okay, I'm going to wait till he tells me to, but it's not really giving me a chance to experience it. And not that I want to fall on my face, but to fall on my face so I can see visually what am I doing wrong.
So what I'll probably give you as your next assignment is to do a covered call. So I'll probably have you to buy 100 shares of a stock, and then we'll have you to sell calls against that. And just to see that, and y'all upload the screenshot again. But no, you're fine. Go ahead and play with that. Have a lot of fun with it. Matter of fact, if you want to go ahead and try AIM with it, go ahead and try it. Do whatever you want to. Play with that. And I'll probably have you do a covered call next. I want you to make sure that you at least leave this class with at least knowing why options are there. Options allow you to reduce your cost basis. So you buy shares, nobody knows how to reduce cost basis. What do you mean reduce cost basis? Well, if I bought them at 100, how could I make it so that my overall cost of these shares is 95 instead of 100? And that's what you're trying to do, is reduce. Because remember, the big secret that nobody tells you, because if we as financial advisors can keep it complicated, we can take your money. But at the end of the day, we know everything that we do is buy low and sell high. That's what we do. We buy low and sell high. Now we can sell high first, then buy low. And that's what options will allow us to do. So you can sell first. I can sell an option on something that I don't even own and buy it back later at a lower price to make money. So we'll show you about early management and how that works as the sell high, buy low. We'll also show you when it's most advantageous to sell options, right? So there are better times than others when you're selling options. We can tell you what's best to do on an up day, what's best to do on a down day in the market. So all kind of things that you need to come away with. But keep in mind, your ultimate goal in our class, your final exam is going to be you putting in on one piece of paper, your little trading and investment strategy. That's what I'm getting you close to. It doesn't have to have aim in it. It doesn't have to have anything, but I want you to know what you're going to do over the next 5 years. What is your plan? I'm going to dollar cost average into the S&P 500 by acquiring shares of SPY. I'm going to buy it once a month or once a pay period, blah, 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 this amount, and stick with it. It's very, very simple. All right, any other questions at all?
What book are we going to do next?
All right, I think we're going to do the 3% book next. I think that's the one. And I'll try to get that posted today, your reading assignment for this week.
Awesome.
Awesome. And keep in mind, it's kind of like AIM, but it's just, all it is, AIM is nothing more than rebalancing systematically. That's what the 3% trigger is. It's rebalancing systematically. So you can rebalance by time, you can rebalance by triggers, you can rebalance by a number of things. It's just all of these books are about rebalance. That's all they are, and different methods of doing that. So this will allow us, I think the 3% method is a much simpler way than Lucello's method, and it might appeal to some of you, but it's an interesting read. I loved going through it and looking at some of the scenarios that were presented in that book. I think it'll be strong for you as well. All right, any other questions at all? All right, roll tide, y'all. I will see y'all Thursday. Y'all doing great work, by the way. Keep it up.